Hi there, everybody. So let's crack on with this series of the top 10 traders who are most copied on Etoro who deal with stocks. So we've already covered Jay Nemesis, we've covered Yepe Kirk Bondi. Now we're going to we're going to analyze Richard Stroud's portfolio. 11, just under 12,000 copiers. Number 3 at the moment. And so far this year, he's returned 51%. Last year it was 41%. Year before that was minus 15. He's got well over $5 million under asset management. You can see the number of copies has grown exponentially recently. In fact, just in the last 7 days, he's added on nearly 2,000, which is an amazing task, amazing feat. Right, let's have a look at his portfolio. So let's have a look at the highest number, the biggest holding he's got. Bitcoin at just under 6%, Alibaba at just over 5%. So let's look at Alibaba. And what we're doing here now is analyzing everything from a very financial perspective, but don't worry, don't feel overwhelmed by what you see here. Lots and lots of numbers. I'm going to break it down for you and pick out the most important things. So for those of you who don't know who Alibaba is, why not? Jack Ma's company. It's a holding company that provides technology, infrastructure, marketing reach to help merchants, brands, and other businesses to leverage the power of new technology. What does that mean? It's like an Amazon Plus, really. They've got so many things. They're huge in China. They've got cloud computing, similar to Amazon, digital media and entertainment, similar to Amazon. Based in China. Biggest shareholder is Jack Ma, richest man in richest man in China and Asia. Now, just having a look at how much he actually owns, he's not even in the top 10 anymore. These guys own much more. Okay, let's have a look at the report now. We've got 85% quality. Now, what does that mean? If you've been following the series so far, it means return on capital, which is here. It's good for the industry. I'd say it's poor if you compare to other companies, especially software companies, other technology companies. Return on equity is good. Operating margin is actually very, very good. If you compare Amazon, which is less than half that, Alibaba's got 16% operating margin. If you look at the financials, you can see the revenue in that graph going up and up and up. In 2018, it was 250 billion, went up to 376 billion, huge increase. And again, in 2020, 509 billion. And it's projected to just grow exponentially. Look at that. It's going to be 1 trillion turnover. Remember, this is in the Chinese yuan. Operating profits growing steadily. Had a dip in 2019, but still 95 billion is not bad. 28.1% operating margin here. 28.1% is the compounded annual growth revenue. What that means is that that's how fast it's been growing. 46% in terms of turnover, 28% in terms of profit, and net profit is 43%. Now, what that means is that for practically every extra dollar it's getting in revenue, it's translating it to the bottom line, because the revenue is growing at roughly the same rate as the net profit. Many companies grow very fast, but they don't necessarily increase their net profit at the same rate as they increase their revenue. Alibaba is an exception to that. That's why the quality is 85. I would have thought it's higher. In fact, there you go. It's gone down slightly. Now the value is 20 for a tech company. That's not bad. We've seen a lot of overpriced companies. In fact, you can see here the share price has been going down significantly. Now, that could be to do with the fact that the spin-off company, Ant Financial, got pulled about this time, and it's had a drag on earnings. That's a different story. I'm sure it's in the news. Price monitoring section, back here somewhere. The Chinese authorities really put a damper on their spin-off of their financial company. Right, PE ratio 21, very good. If you look at other companies in the US, they're in the 70s, 80s, over 100. PE ratio, price earnings ratio, is the most common used metric for valuing a company. And what it means is that the higher it is, the more expensive it is. So this is in line with, not too far out from the Chinese market. In fact, this is comparing it to the US market. But if you were to compare it to the industry, very good. The PEG ratio, the PEG ratio, if I can say it, price earnings growth ratio, anything below 1 is a steal. Dividend, there's no dividend here. And again, this is one big hang up I have about these companies. Look, they're sitting on so much profit. Look at the cash flow, 410 billion. And it's got lots of net fixed assets. It hasn't got any debt. It's a huge company with lots and lots of cash. They could easily afford to give some dividends back. Momentum is 69. How do we know that? Because looking at the relative strength, I've been into detail about what that is in the last few videos, but basically you're looking at how it performs versus the market. And you can see it has been not performing very well. You can see that in the share price. In fact, you could probably see it more here in the last 3 months. Let's look at that. So the share price has really been low. I think this is actually a very good company to buy because it's going to bounce back. So that's Richard's biggest holding. Citigroup is his second one. Let's look at the financials for Citigroup. Citigroup has got a quality of 27, which is really poor. Right, you all know what Citigroup are, don't you? The big bank. They call it a diversified financial services holding company. I suppose it's a bit more than a bank then. The company provides a range of financial products and services, including consumer banking and credit, corporate investment banking, securities brokerage, trade and security services, and wealth management. Its business segments include global consumer banking, institutional clients, and corporate other. Based in New York. And let's have a look at it. 27 quality. Return on capital is only 0.6%. That's terrible, both for the industry and the market. Return on equity, not much better. Operating margin is actually very good for the market, not so much for its industry, for fellow banks. But I'd say 18% is not bad. Let's look at the revenues. Revenues have been static, you can see, haven't gone anywhere. It was in fact, in 2014, 6 years ago, it's 77 billion, and it's still 77 billion. In fact, 2021 estimate it's going to go down to 70. Have the operating profits have been seesawing a lot. 6 years ago, it's 14 billion. Now it's still 14 billion. Net profit has gone up and down a lot. In 2017, had a huge loss of nearly 7 billion, probably write-offs, but it could be selling off a portion of their company, maybe, or maybe even a merger. Need to look into that a bit more detail. One good thing is that they got a very good dividend yield, which is why the value is 89, which is really good. It's the highest we've seen for a long time. So PE ratio 10.7. This is very cheap, but it's not a great quality company. PEG ratio, anything below 1 is good. This is very good in terms of value. Dividend, so if you're only after a little bit of income, then why not? In fact, let's have a look at Richard's, how much Richard's made on this, 18%. That's not bad. Momentum is 53, it's not that fantastic. Share price, how has it been doing? Let's look at year to date. So pre-pandemic, it was 76, now it's 59, hasn't recovered. So many other companies have recovered. This one hasn't, and it's still a good 15 to 20% below its pre-pandemic rate. And even if you look at the last 5 years, it's been very choppy, up and down, up and down, up and down. And here as well, big drop here, obviously. But it's climbing, having said that. It was at 41. That's gone up to 59. That's probably where Richard's made the money. Okay, let's go on to the next one. Disney. We have covered this before, so I'm not going to cover it in a great deal of detail. Everybody knows who Disney are. And interestingly enough, one thing I did want to highlight is they make more money from their theme parks than from their films. And they own all sorts of things. They own the Star Wars, Pixar, they own so many film catalogs. Quality 65, value 15, momentum 65. What does that mean? Quality, return on capital employed, is actually minus. And there you go. That's why, because it's made a huge loss. Obviously, their parks are closed, the cinemas are closed, so they've taken a huge hit, minus $2.8 billion. Wow. But compared to where they were last year, 11 billion profit, and the year before, 12.6 billion. So it's an incredibly profitable business. But this year they've taken a big hit. Next year they're planning on making 5 billion and getting back up to 9 billion in 2022. Let's see how their cash pile is. Well, they're generating quite a lot of cash, free cash flow per share is really important. I mean, it wasn't as much as it was in the past. I'd like to see them get back up to 6.52 for 2018, which is just cash machine. They are sitting on nearly $18 billion of cash, so they can easily afford a 2.8 billion loss. They can weather the storm quite easily. They have also got a huge amount of fixed assets. That must be their theme parks and all of their, but they've got a lot of debt as well. 41 billion is no mean number. They've got a lot of debt. The value is 15, which isn't very good. Now, what does that mean? PE ratio 58, that's very expensive. This is an overpriced stock. And although it gives a dividend, which is good, it's a very small dividend. I think they're going to suspend the dividend given the losses they've made. It did jump 15% just the other day. You can see that there. Okay, so what's Richard got here next? Tencent, which is 700. Everybody should know Tencent Holdings, huge Chinese company. But let's go through it. Right, Tencent Holdings is an investment holding company principally involved in the provision of value-added services and online advertising services. They're a Google Plus, the Chinese equivalent, but they do things like mobile games, online advertising is their main business. Right, let's have a look. So 96 quality, fantastic. That's brilliant. 16% return on capital, 33% operating margin. That is fantastic. And you can see that in the numbers. Look at that. Look at that chart. Revenue has been just going up from only 6 years ago, it was less than 80 billion. And now latest accounts show 377 billion, and it's just going to increase and increase. You can see the earnings estimates 480 billion, 595 billion in 2021. Compounded annual growth rate of 36%. That is, it's just outstanding. It is, it's a brilliant company, fantastic. Look at the net profit. It must be sitting on so much cash, tens of billions of dollars. Here, 154 billion net profit, and this is all in Chinese yuan. Let's look at the cash pile, 235 billion. Huge amounts. Hardly any debt. Now, its value is only 7, which is a danger signal. P ratio 29.6. We've seen much higher, but compared to other Chinese companies, and remember this is listed in Hong Kong, it is very poor. Dividend yield, oh, it does give a dividend, fantastic. I'd like to see tech companies giving some money back. By Chinese standards, it's overpriced. By American standards, I say there's still a lot of room for growth in the share price. Momentum 97, that means it's growing really fast. Although this is a bit funny. Relative strength is minus. So that, and it's off the 52-week high as well. There must be other reasons for its momentum to be so high. And it's not reflected really in the share price. Okay. So what could it be? Momentum is really about how it's performing in terms of volume as well, and price and relative strength. I'd have to look at that in a bit more detail. But you can see here 520 billion market cap. I think this company's got a bright future. It's got a lot more to go. Now, Richard's next one is Gazprom. I don't know, OGZD. OGZD. That is the Russian oil company. It's listed on the London Stock Exchange. And what we have here is gas pipelines. It's really a Russian state company. Huge, really is massive. It's got the backing of the Russian state. Now, in fact, you can see probably from its major shareholders, the largest shareholding is by Capital Research. Most of the 97% is owned by the Russian government. It doesn't say that here. I don't know why. They should do. Quality is only 37. That's not very good. Return on capital is 2.3. So it's good for the industry. And the reason for that is because it's an incredibly intensive, capital intensive business. Return on equity is actually minus. Operating margin is very good at 7.5. Value is 82, which is really good. P ratio is only 3. I think this is a very good value stock, but it's not in a very beloved sector of the marketplace. That's one problem. Second problem is that it's owned by the Russians. It's got poor, well, let's have a look. It's, oh, wow, look at that. Dividend yield 14%. Do I believe that number? Let's have a look. It's not showing free cash flow per share. Actually, it's negative, minus 26 and minus 5. But it's still giving out a very healthy dividend, which means it must have a big stockpile of cash and it's working from its reserves. There you see it. Net profit is minus 64 billion Russian rubles. I wonder why that's the case. Is there anything in the news, I wonder? Why has it made such a big loss? Maybe something to do with that? I'd have to look in a bit more detail. All right, let's go to the next company. QSR Now this is an interesting company. Restaurant brands. So who are they? We all know because we've eaten out at their restaurants. Company has approximately 27,000 restaurants in 100 countries, as well as United States territories. It owns 3 quick service restaurants, Burger King, Tim Hortons, and Popeyes. There we go. Now, Burger King is obviously their biggest holding within that group. Quality is 82, very good. Return on capital 7.4%, which is good for the industry and the market. Although we've seen a lot higher in other sectors. And operating margin is fantastic at 30%. Let's see if that's translated into the revenues and the profits. Now, this is a bit disappointing. Revenues have been fairly flat for the last few years. And I'm sure they've taken a big hit this year. Operating profit has been reasonable, but again, flat. Net profit, now that's something big has changed here, hasn't it? I would have thought that would have been a loss because all the restaurants are closed. They must have a lot of drive-throughs, but this seems a bit strange to me. Net profit's gone up from 560 million to 996 million, nearly $1 billion. That's doubled, and they're expecting it to grow by another 26 to 30% the year after. That does beg some questions, how they managed to do that. One of the things I love to see is free cash flow per share. The higher that is, the better. This is a cash generating business. You can see 1.9 billion sitting on their balance sheet in cash, which is more, it's like 4 times their annual profits, which is good. Okay, so value is 47, which is good. Momentum is 46, which isn't fantastic. Right, let's move on. Target, TGT. Uh, 94, right, who are they? Of course, yes, American retail company. General merchandise retailer selling products through its stores and digital channels. They do a bit of everything, actually. They also own brands as well. Archer Farms, Market Pantry, Sutton and Dodge. I haven't heard of these. Must be big in America. Wine Cube, Cat and Jack, Simply Balanced, Wonder Shop. 1,535 owned stores, 107 leased stores, 161 buildings on leased land. Osh gosh, got quite a lot of reach there. Minneapolis. Right, so quality 94, return on capital, good, return on equity, good, operating margin, good for a retailer. It's very good. Now, value is at 60, momentum 90. This is actually a very good company. How has it been reflected in the share price? It's been going up, but recently sliding down a wee bit from 179 to 100 to its current level now. Okay, so Target is a good quality company. I generally stay away from retailers, but this company's got a decent future. I mean, if you look at the projected earnings, it's not going up by a huge amount, nor is the profit. It's very stable. And it's sitting on a decent cash pile as well of nearly $6 billion. Okay, so let's go now. Let's do one more. SIE, Siemens. Just make sure I get the right one. I think that just means Germany. SIE, Germany, Deutschland. All right, we all know who Siemens are. Let's see which part of Siemens this is. Siemens AG is a Germany-based technology company, operates through 7 segments, digital industries, which offers products and system solutions for automation used in discrete and process industry. God, this is a bit technical, isn't it? Smart infrastructure, gas and power, oil and gas related operations, mobility, freight transportation, Siemens Healthineers, supplies technology to the healthcare industry, Gamesa renewable energy. I think J or Yepi's got that. I think Yepi's got that, which designs and produces wind turbines and sells wind farms and financial services. Based in Wittelsbachel, München. Oh, Munich. Okay. So, oh gosh, the quality isn't that good, is it? 48. Return on capital is only 5.6. It's not good compared to the market, but good for the industry. Return on equity is okay, nothing special. Operating margin is low. For a technology company, it's really poor. We've been seeing 20, 30 plus %. This is below 10. Let's look at its revenues. Oh dear. Big hit in 2018 to 2019. It dropped hugely from 83 billion euros to 58. Now it's climbing back up slowly. They probably sold off one of their divisions. Operating profit wasn't hit as badly as revenue was. So they probably sold a low growth, low operating profit business off. Net profit hasn't done much, has it? It hasn't got back to the 2015 levels of 7.2 billion. I would say this is not a great company looking at the revenue and profits. And if you look at the value 51 and momentum 35, what is there that we can pick out here? I mean, look at the share price. This is 1 year, went down. Pre-pandemic, let's say, beginning of the year, it was 118. It's now 115. So it's recovered. Went all the way down to 60. So it's nearly doubled. So it's probably brought him in some money, hasn't it? Oh, why is it your minus 1% with a 4% holding? That's not good. I mean, the share price has gone up quite a lot, hasn't it? He must have bought it somewhere up here, like 118, somewhere around there, beginning of November, maybe. It hasn't done anything since then. Okay, so let's have a look. I've put in all of Richard's top holdings, top 14 holdings. I can't do it for Bitcoin, obviously, but I've done it for all of these other companies. And the quality is 77 on average. Now, the reason it's fairly good is because Microsoft, Qualcomm, NetEase, there's quite a few. P&G, very good company. Thor Industries, 92. There's quite a few 90s, but this one, Citi Group, is letting him down. Disney's bringing him down a little bit. Siemens is definitely bringing him down. And Legal & General, that's really dragging it down. Otherwise, without one or two of those poor quality companies, he could be much higher. Value is very good. And I'm going to compare it with Yepi and with J in just one moment. And momentum is 65. So in terms of value, what's bringing it down? 10 cent. The rest of them are fairly reasonable. Momentum is good as well. So let's look. Let's color this in red. So when we compare Richard Stroud's quality of portfolio, it's much better than both Yepi and J. And when we compare his value as well, it's not quite as good as Yepi, but much better than J's. And the momentum is better than Yepi, but not as good as J. Now, what does this all mean? It means he's got a very good quality portfolio. I'd say good value, but momentum isn't so great. You may have to hold his portfolio for longer before momentum comes back in. But it will come back because he's got good quality companies in there. Let's look at these kind of issues now. Sector diversification. So he's got media, he's got technology, he's got banking, he's got retail, he's got GSK is the pharmaceuticals, he's got insurance. It's very good, very good. International, well, he's got China, America, UK, Germany. And when we compare it with the other two, it's much better in terms of international. Non-US tech versus the rest. So let's see how many big US tech companies he's got. I'm not counting Alibaba. I count that as Chinese, although it's listed in America. US tech companies, well, there's Microsoft, Qualcomm, chips, NetEase, although again, that's Chinese. They're very good. Right, cash holding, let's look. So I like to see between 5 and 10% cash holding. Rich has only got 1%. So that's a weakness in his portfolio. If there were opportunities, he would not be able to look up, pounce on them so readily unless he bought money from outside or he sold. So I'd say it's poor. Number of companies, ideally we should be looking at 15 to 25. I've been in the reasons for this many times. Statistically, 15 to 25 is the best number. He's got 27, which is not far off. I'd say this is a very good portfolio. Let's look at his most profitable companies. So what you want is the highest profit with the biggest holding. He doesn't have that. His biggest holding, remember, was Bitcoin, Alibaba, and Disney. So where do they come in? Way down. There's Alibaba there at 30%. Bitcoin here at 6% at the bottom of the screen. But it's not bad. 2% here, 4% versus a profit level of 68, just under 50% for Target. He's done really well. This is a good portfolio. I would imagine, in fact, I would expect to see more than 51%. Maybe he sold too early. Okay, let's have a look at some of his losses. Bluebird Bio, he's got a decent holding in it, 26% down. GlaxoSmithKline, minus 16. Let's have a look at GlaxoSmithKline, GSK. What's happened to their share price? Share price for GlaxoSmithKline is a good quality company, and it's massive. It's 68 billion, one of the biggest in the UK stock exchange, and momentum is reasonable. Share price took a dip here. See that? 1304. At the moment, it's 1364. It's climbed up again. Now, Richard must have bought it to lose 16% of the current share price, which is 1364. So he must have bought it for about 15 something. So he's bought it up here, around here. And it's been steadily going down. In fact, it went down quite significantly here, spiked up again, and it's going down again. Why is that? What's in the news about Smith? British spend $5 billion. I don't know if we'll be able to tell. I think they're just not in the right part of pharmaceuticals at the moment. Okay, so losses there. Losses with Sanofi as well. I think that's another healthcare company. So looking at that, the number of companies is actually very good. So summarizing it, good quality companies, reasonable value, a bit lower on the momentum that I'd like to see. His weaknesses here are going to be legal and general. That's dragging the portfolio down. I'd like to see more cash. And I would like to, this company is not very good as well, Citicorp. and he's had a couple of bad companies. If those were stripped out of the portfolio, maybe he could sit on more cash and take advantage of better opportunities, or buy them now. Increase his stake in those companies if he thinks they're going to recover. What I would do, just add to the portfolio of Bluebird and GlaxoSmithKline and Sanofi. Increase the overall holdings. You're going to dilute the losses. When they recover, you'll make more profits. That's what I would do. Now, compared to the others, quality is there. It's got a much better quality portfolio. I think this guy is going to do better than these two next year. Anyway, that's just my opinion. I hope you enjoyed this video and see you guys very soon. Let's go to the next one.